What's up, guys? Welcome back to another video. Thanks for tuning into Stock Essentials. My name is Alex, and today we're going to be going over just overall market consensus. As we can see with SPY, which is the S&P 500 ETF, tracks the top 500 U.S. companies. We're at all-time highs. We're sitting at all-time highs during a pandemic, right before all-time highs. Right before the pandemic, SPY was sitting around $337. And then during COVID, it crashed all the way down to $228 before recovering all the way to $440. So we're sitting at all-time highs, and a lot of people think that there's going to be a crash, especially with the inflation during the pandemic. The Fed printed out tons of money, all the stimulus checks, all the government spending. There's tons of inflation going on, so a lot of people are afraid of that, especially with the Delta variant of the coronavirus spreading around. A lot of people are getting worried again. Will we have another crash, just like March? I don't think it's going to be as severe because this is a new wave of investing, new wave of traders here. It's the retail investors. Tons of people who were bored at home. A lot of the young folks decided to, download apps like Robinhood, Webull, to just got into investing because everyone's stuck at home. They're bored, and they wanted to, just look for other ways to make some quick cash, and they did that by doing a lot of options plays. So SPY, we're sitting at all-time highs. We don't know whether there's going to be a crash or not. We might see some minor pullbacks. I don't think it's going to be as severe as this March crash was. It's just because a lot of people didn't really know what to expect. And since a lot of people now, they know that all these stocks, they can recover pretty quick. Everyone has a better sense of the overall market, what stocks to buy during a pandemic, stuff like that. So I don't think a crash would be as severe as it did back then, just because we kind of know how to prepare for another pandemic, especially with the stock market. And the best strategy is actually to buy and hold. As we can see, this nice uptrend. If you just held SPY or even bought it at the all-time highs before the crash, you would be making some pretty nice profits. In the past year, it's up 34%. And overall, the market returns around a 7 to 10% return. So seeing it up around 34% is pretty nice. In the past years, you pretty much doubled your money, assuming you buy in around $200, which is pretty nice. Or if you bought in during the March crash, you bought the lows, you would be basically doubling your money on SPY. Now, obviously, there's a lot of individual stocks who have provided a lot better returns, but for SPY and a really safe ETF index, just as this one, that's some serious returns in a short amount of time. So a lot of people think that there's going to be a pullback, and there very well might be. So we will be going over some ways to hedge your portfolios, especially if you have a bigger account. You definitely need some hedging in there. But if you have a smaller account, it's nothing really to worry about because you're not losing as much capital. If you take a look at the options market summary, more people are preparing for a crash or just hedging their positions, and they do that by buying puts. Puts is basically an option contract where you make money where the stock goes down. So they're doing that on SPY as well as QQQ, which is the tech index, very popular one. And these are the two most popular ETFs out there. They pay some nice dividends, and they're overall just buy and hold forever in your long-term portfolios. But as we can see, puts are outnumbering calls by a large amount. So right now, the market's pretty much being held up by mostly tech, especially like Apple, AMD, Tesla. But a lot of people think that the market's like overinflated, especially with inflation going on, and people are just worried now. So we just need to, if you're worried yourself, is some ways to hedge your portfolios. First one is obviously buying put options. And you can buy some really cheap put options, as we can see here. Just buy a few put options, maybe like a week or two out. Nothing crazy. you'll make a lot of cash if SPY does crash, and it will save your portfolio. But if you do have like 100 shares of a stock, you could also sell some covered calls. That's a really good way to hedge your portfolio. But buying some puts on the overall market is a really good strategy. And if you don't want to do options, if you don't have options enabled for your brokerage, you could also buy some inverse ETFs, such as VIX, which is or VXX, which is basically it just tracks the opposite of SPY, as we can see here. During the March crash, SPY or VXX rose from around $54 all the way to $242, and it's sitting at really low levels right now because the markets are all-time high. And it basically tracks the fear index. So if fear goes up, this ETF is going to grow in value as well. And you don't even have to play options on this ETF. You just buy and hold shares, and over time, it does lose value because the market tends to go up. But in the short term, this is a very good ETF to buy and hold in your portfolio if you do want some hedging action. You can also trade options, but just buying and holding shares on this ETF is pretty good as well. But that's about it for this video. If it helped you in any way, please leave a like, comment down below what your thoughts are on the overall state of the market, and of course subscribe if you're new to the channel. It helps a lot. Thanks for watching.